Welcome to NDTV Profit. This is Nika Barwe, and today we're joined by the CMD at Railtel Corporation, Mr. Sanjai Kumar. Good afternoon, Mr. Kumar.
Good afternoon.
Yes. So we'll start with the Q3 earnings. Railtel net profit has seen it's almost doubled on a YOY basis. However, there was a sequential drop on the net profit. Could you maybe highlight what led to this drop this quarter?
So if we read the quarterly numbers. So actually, mostly the project which guides our overall results also. So it matters what kind of basket of projects are getting implemented during that quarter. So, and some projects maybe with the lesser margin, some with the more margin. So it's a one-off kind of incident. I don't see any specific reason for this. Yeah.
It won't be sustained in the next quarter. It's just a one-off.
Yeah.
Okay. And in terms of the revenue mix, I mean, the contribution of the project work segment has increased approximately by 14 percentage points. What is the targeted revenue mix that the company is aiming for?
So overall, if we talk of FY24, I would say that we'll maintain the momentum, and then we'll be somewhere around 2,500 plus crores overall if we talk of the entire year.
And what is the revenue mix ratio in terms of telecom?
Revenue mix would be around, can say 1,400 from roughly 1,400 from projects, and then maybe 11 to 1,200 from telecom.
Okay.
Exact numbers, yes, I can't say now, but yeah, this would be the mix.
Yes, and the company also secured significant orders throughout the third quarter. Where does the total order book of the company currently stand, and what are the expectations for the next quarter?
So right now we stand at around 4,800 plus crores, and we expect that the balance order book at the end of the year will remain in the same range, 4,500 to 5,000 crores. Yeah, so we are getting continuous orders.
Okay, and in terms of the timeline for execution of the current order book, what is the timeline the company is foreseeing?
So what I see, at least for the next year, we expect that out of this order book, around 1,400 crores would be implemented, will convert into revenue, and this quarter as well, we are expecting somewhere around 500 to 600 crores.
Okay, and for the upcoming quarter, that's right?
Yeah, current quarter, yeah.
You mentioned about the near-term earnings visibility, and what about the balance? Apart from the 1,400 that would see in the next fiscal year, what is the kind of earnings visibility that you do see from the remainder order book?
For the next year? Talking about the next year?
For the next, over the next 2 to 3 years, the kind of earnings.
Actually, this order book generally comprises of various segments. So some part of it is CAPEX, part of it is AMC, which might range from 5 years, 3 years, 8 years, even 10 years. So those kind of elements are there. So, but what I can see that next year is, I told you, 1,400 odd numbers. And beyond that, out of this current project order book, would be around 400 to 500 crores. And likewise, it's spread over next 4 or 5 years.
And in terms of the order book target for FY25 for the next fiscal year, what is your target?
I would say that on conservative side, I can say that 3,000 numbers we should get new orders at least.
And in terms of the segment breakup, what are you all anticipating?
So railway signaling works, then LT Kavach works also we are eyeing, then new orders coming from education, health also we are is on our focus. Then smart city phase 2 is also coming up, as we know from the market, and that's newer sector where we are focusing now. Then usual normal digitization project, which are data center or related projects. That is the kind of spectrum.
You mentioned you all are focusing on healthcare and smart city. Do you all have any terms of expectations in terms of order inflow for the next 2 to 3 fiscal years from these segments specifically?
Not exactly. Now we haven't worked out on that, but yes, we are getting small orders, not very big orders.
Okay. And lastly, I would want to ask, what are your budget expectations for the upcoming budget in terms of, the railway allocation and the kind of expectations that you have in mind?
See, last year railways had 2.41 lakh crore. This current year means by 24. So certainly is going to be more than this. As far as Railtel as a company in this sector is concerned, so there's a budget already forecasted, and that is around 1 lakh crore over next 5 to 6 years is going to be spent in signaling and telecom. So that's what is important for us.
So you all do expect a double-digit growth. You all do expect an increase in terms of the allocation.
Yes.
Okay. Thank you so much for joining us today.
Thank you.
It was great talking to you.
Welcome, you're watching NDTV Profit. I'm Harsh Saita. Let's quickly, delve into the earnings, some of the earnings impact that we are starting to see today. one of them being on Cholamandalam Investment and Finance Corp. Now let's try and understand, break these numbers down a little bit better. We have with us the management of Chola, and we have with us the CFO, Mr. Arul Selvan. Good morning, sir. Welcome to NDTV Profit.
Good morning.
Sir, help us first understand the backdrop of the kind of growth that we are seeing with regard to AUM, whether that's sustainable, and also you are expecting bullish trends even in Q4 with regard to how CV is playing out. How is it playing out? We've almost seen now almost a month of Q4 done. How are some of those trends playing out?
Yeah, I'll talk about overall expectations. Specific Q4, I may not be able to talk because then it will be more like a forward-looking statement. We generally don't do forward-looking statements. So overall, our growth for the full year would be in the range of around 30%, 30 to 32%. That's what we are targeting. As you would have seen, what was 47% in the first half has come down to around 36% now in the end of Q3. On a AUM basis. This is primarily because last year the base was higher in the Q3, Q4. So you'll see that moderation happening because of a reduction in growth percentage because of the base effect coming into play. Absolute values, it will grow. But the 30-32% growth is what we are targeting for this year. CV growth is good. The CV growth will continue to be good, but we will focus on growing in certain segments, considering our cost of funds, considering our growth aspirations in certain geographies, etc.
What would those specific pockets be, if you can give us some insight?
No, sir. Sorry about it.
Sure, understood. Fine. With regard to some of the new businesses that you're entering, the mix it seems to be shifting more towards new businesses. I want to try and understand what those new businesses are. I do understand that you're doing smaller ticket size, but how is it different from what you're doing currently?
See, we had predominantly been a vehicle finance, focused business. I'm talking a few years back. Then we progressively brought in loan against property and home loans. These have been now it has for the last, 15 years in the case of loan against property and around 8 years with regard to home loan. And last 1.5 years back, we brought in 3 new businesses, which is the consumer and small enterprises loan, the secured business personal loan, and the SME loan. Our focus is now to grow the LAP and HL. While we will grow all the businesses, the LAP and HL growth rate, you will see it faster. You will already seeing that faster happening in the quarters that went by. The vehicle finance while it will keep growing, it will lose its lion's share and it will become a slightly smaller percentage. Right now, as you would have seen, it has moved down from 75-76% to around 60% this quarter, while LAP and the home loan is taking almost like around 31%. The new businesses, because they have come new and there is absolutely no base, their proportion seems to be high and they will continue to grow. They will be in the range of around 10 to 15% as we close this year and as well as over the next one year or 2 years. In the next few years, you will see vehicle finance becoming around 50% of the overall book, and the mortgage businesses, the LAP and home loans will become around 35% of the business, and then 15% would be the new businesses.
Understood. That's quite a comprehensive coverage. Now I want to try and also break this down further. So what part of your book is secured? That's probably how I want to first start off and then delve deeper into the loan mix.
Yeah, other than the consumer and small enterprises loans, which is almost like around 6% of the book now, rest of the businesses or rest of the portfolio is completely secured. We may have some trade advance, etc. in vehicle finance business, but that's a very insignificant number. But overall, 6% right now is will be the unsecured element in our book.
Understood. And would that start to creep up slowly as you move from 11% on your business loans or other loans to, or new business loans to 15% with regard to the mix?
No, the overall book in the case of CSL should not be more than 10% even over the next 2 years.
Right, that makes sense. And does you spoke about how you wish to also grow your housing and LAP. That comes at lower yields. So would that therefore also pressure margins, or would that largely be offset by the new businesses that you're doing?
The home loan is a higher yield and a higher ROTA business. If you see the we have shared the investor presentation, the segment which we focus on home loan is not the salaried segment, and so our yields in this business is much higher, and ROTA is higher, and it is focused on tier 3, tier 4 towns and cities. So there the appetite for a home loan from self-employed non-professionals, which is what our entire customer profile in this portfolio consists of, is a slightly higher yield giving segment. So we will stand to benefit by growing this book. Even in LAP, it is while the yields are lower because we are addressing the upper strata of the SME segment there OpEx is lower, and their NCL is very negligible number. So they again tend to give a higher ROTA, and so this business is also ROA accretive for us. So we find these businesses are good to grow, and we will keep a track of their profitability, and we will certainly make sure that overall businesses we focus on and grow are ROA accretive.
Understood. And with regard to where your credit costs lie, you've guided for a 1 to 1.2% credit cost kind of a number, at least that's what you're targeting. Now, with some of these new businesses coming in, with you lending to a slightly different niche, would that by any chance pose a risk on this credit cost number?
No, maybe this year we may close the year with around 1.25% taps because more in the traditional business we've seen a certain spike in credit cost. But I think we should be over a cycle. We should be holding it between 1 to 1.2%, and that's what our focus will be to do, irrespective of the business segments which we are in.
Understood. And what gives you that confidence? Because is it existing customers you're lending to? Is that what gives you the confidence, or are you managing things differently, better?
Yeah, see, if you look at it, Chola is more a collection-oriented organization. Our vehicle finance customers are not, the cream of the vehicle finance customer profile, but still we have sustained and we have kept lowest credit cost in the segment which we operate. Likewise, we will endeavor to do it. We have a separate collection vertical which focuses, and this is separate for each of the businesses headed by separate people, separate teams working on it. And so the way we handle collection is different, and that is where our uniqueness comes in, and we manage the collection effectively from that angle. So we are confident that we should be able to hold it at this level.
Sure, sir. And my last question, very, very quickly, if I can try and understand trends with regard to cost of funds and margins. Your cost of funds have gone up just a wee bit sequentially, margins largely flat. How are you able to maintain this in this kind of an environment?
The cost of funds is, in my opinion, cost of funds has peaked out, and it should while I don't subscribe to the yearly rate cuts, it should hold here and improve from here. Certainly, we have very good support from the lenders, bankers, markets, etc., and we get good cost of funds and very finer rates from them, which helps us to keep our cost of funds low. On the other side, we have been constantly increasing the yield. The vehicle finance book, which has been a fixed rate book, as progressively changing the overall book yield, because the higher yield book is becoming a larger part of the portfolio, and you will see that also helping in improvement. So my view, unless something drastically different happens in the environment, either regulatorily or global impact, etc., we should be able to improve our NIMs in the coming quarters. By how much? Oh, that's something I don't want to share right now. It will be incremental. It is not going to be any big game changer, but it will be a positive direction upwards on the NIM. Sure. Understood. Thank you so much, Mr. Selvan, for speaking with us today and for giving us all of those insights.
That was, of course, the management of Chola Finance, and we'll keep a track of that stock as well through the day of trade today. But more on the other side. Stay tuned to NDTV Profit.
Now, India's experience in crafting DPI and its leadership has become a testament of its commitment to leveraging technology for a nation's progress. The DPI's emphasis on having shared building blocks and supporting innovation across the system has emerged as a pivotal and applaud-worthy approach in the global landscape. While some consider DPI to be a shared means to many ends, it still is an evolving concept. And to talk more about this, we have with us Mr. T. Koshi, who's the MD and CEO of ONDC, a new-age network-based open protocol that is believed to be the next game changer after UPI. Mr. Koshi, thank you so much for joining us for this special conversation. And I would like to start this conversation with you about the increasing role and the importance and the threats of AI, because AI has been a part of several conversations now and is increasingly gaining importance. So if we look at the role of ONDC in India's DPI, how can the protocol dovetail with AI better for its effective use?
As you would have understood, the idea of open network for digital commerce is broad-basing the participation. How is it made possible? It is by unbundling the building blocks of commerce and make them interoperable. When you look at the role of AI and how it can really make this more powerful, that you would see opportunities explode in two ways. One is that when each of the building blocks are going to be developed by very specialized agencies, they would realize that AI is one of the very powerful tools that can use. In the old world of e-commerce, there are only a few large players. I'm sure that they are using very, very advanced AI solutions for themselves. But the thing is, the opportunities are limited to few large platforms, either in consumer product 2 or 3, whether we are in food, you have 2 or 3, in mobility, you have 2 or 3. Whereas ONDC would see a proliferation of very specialized enterprises coming, and their service level can be significantly enhanced and help them to make it very, very focused and relevant to their consumer setters of sellers or buyers. And it will be AI, and AI, in my opinion, will really fast forward this adoption. One. Second thing, way in which ONDC and DPIs, etc., will make a big impact is that when there is a larger adoption, you would see a very broad-based participation from the industry. Today, if you look at commerce, the buyer side, we have a penetration of 7 to 8%, seller side 1 or 2% or 3%. Buyer side is meant to a certain privileged class of the society, whether it is a big cities or small cities. Now, when you have a broad-based participation, each of these enterprises will have a significantly large amount of participation from small micro enterprises on seller side, buyers from villages to small towns, etc. And that data itself is something that will help to feed the AI models and make it more meaningful. So that way, ONDC kind of DPI will benefit from use of AI, will also contribute in an evolution of AI.
Right, Mr. Koshi. I'm really glad actually you brought these points about what you said, because so far India's DPI functions like a public interest layer on top of which the private is constantly innovating. So if I have to take this point forward, do you see these dynamics changing in the future? Perhaps the role of private players in navigating the daily workings would also increase?
Yeah, that's true. Like what you said is true. The whole idea of DPI is to create the rails. And the rails is evolved in such a way that it can be used by different segments of users to make it relevant for their clients. So with more and more DPIs becoming proliferating, and then they all use this idea of interoperability, you would see the exploding linkages. For example, as you have already seen in the ONDC, goods side, service side, financial products getting interlinkage, tomorrow complementary insurance product coming, and then helping in micro investments. And eventually, like for example, even we have seen other similar kind of open protocol-based solution in the health sector shaping up, which is seamlessly integrating. So all these things will strengthen the possibilities of very innovative digital solution, which essentially will come from the private sector. And AI is one of the tools for them. So you would see a broad-based participation of private sector in building on this rail that is being made by the DPI. That is the original intention of DPI itself.